let's first move to our top story, and that is on oil price rallying on the back of escalating Middle East conflict and the potential global supply chain disruptions. In fact, both the crude benchmarks are all set to end the week with strong gains of almost 9%. Currently, the United States administration is also contemplating extending support to Israel in its plans to attack Iran's oil fields. In fact, the OPEC Plus has, however, assured that it has enough spare capacity in case of Iran supply getting hindered. All right, so shifting focus then to the United States as well, wherein some key economic data has come out. While the Labor Department has released the jobs report for the month of September, and these figures have come in better than expectations. Unemployment rate has dipped to 4.1% from 4.2% in August. And in September, job creation also advanced. Employers added 254,000 jobs in September that month versus 159,000 jobs that were created last month. And on the back of that, we're seeing the US stock futures rallying after all of that important jobs data pre-market. The Dow Jones closed yesterday by 200 points lower on the back of the news flow coming in from the Middle East. Remember, these pre-market advances that I just told you about on the back of the jobs report are definitely marking a turn after mounting geopolitical tensions in the Middle East. They have given way to a shaky start for the month of October. Let's now then shift focus to how the markets have opened. Well, the Dow Jones, the Nasdaq, the S&P 500 all trading in the green as of now, marginally up, although we'll have to see how this plays out during the rest of the day. All right, then let's welcome our guest who's joining us tonight from Oslo, Bjarne Shcieldrop, the Chief Commodity Analyst at SEB. He's going to be discussing what's the future ahead for the markets and, of course, oil amidst all of this uncertainty playing out. Thank you very much, Bjarne, for joining us once again right here on ET Now.
Thank you for having me, Smita.
Yeah. So Bjarne, mild recovery being seen right here in India. Yes. So mild recovery being seen right here in India, but the bears took charge again, and now you have news coming in that Israel is planning attacks on oil rigs in Iran, and Iran planning attacks on Israeli infrastructure. There is that kind of uncertainty coming in, and then you have the US presidential elections. What further correction are you expecting so far as the markets are concerned, although we're seeing some encouraging data on the jobs front coming?
It's definitely a lot of things at the same time. But I think if we look at the jobs data which came out today, it was definitely positive for the US equity market, but also positive for the oil market, because in general, the market have been very concerned. Will it be a hard landing, soft landing, or actually no landing at all, just sort of positive gains in the economy? And the latest job report was very positive in that respect, and sort of reduced sort of some of the fears that we are actually going to have further deterioration in markets, and gave optimism. And we saw that in gains in both equities, but also for the oil price. So the higher oil price today is not just about fear of disruption.
Absolutely. We'll come to discuss oil in just a bit from now. But let me also take you to the Biden administration's, alleged statement that he would want to support a proportional response. He would not really support a nuclear attack. I want to understand, will that deter Israel? Because we've seen, more escalations happen in the past 24 hours alone, with Israel reportedly planning to attack Iran's oil reserves as well. And at this point, Iran is seemingly more vulnerable to get struck.
What we do know is that Israel will retaliate on Iran. And the big question is, what type of retaliation will it be? And I think at the moment, when you look how markets react, the markets are expecting that it will be like in April, a quite muted retaliation with no big damage. But I think there is definitely a much higher risk for the fact that Israel might actually go hard-handed with its retaliation. Probably not on nuclear installations, probably not on oil infrastructure, most likely on military installations, potentially trying to take out ballistic missile launch sites that could be it. So
Yes.
market is expecting a very muted retaliation in most likely just a couple of days.
Okay.
And that is a big question. Will it be muted or will it be hard-handed? And will it be heavy on military installations and potentially oil infrastructure?
Right. So beyond, are the markets factoring that in?
No, I think at the moment the market. I mean, look at the oil price. I mean, it's not even $80, and we used to trade normally around $80 to $90 just a couple of months ago, and now we haven't even been able to climb out to $80 yet. So the market is pricing in a repeat of April with muted retaliation.
Okay, so you're saying that muted retaliation will probably come in from Israel, although that's not what Israel is suggesting. In fact, the kind of statements that have been made by Prime Minister Benjamin Netanyahu over the past few days. But speaking of oil, Bjorn, Israel, like I said, is reportedly planning to hit Iran's energy infrastructure. As of now, you say that there is not much impact so far as oil prices are concerned. This is absolutely normal, and this is going to be a repeat of what happened in April. But what if that infrastructure is targeted? Some experts are bracing for oil to ratchet up to hit that $100 billion mark in worst case scenario. Would you disagree or agree with that?
I think if Israel indeed goes hard-handed on oil infrastructure in Iran, then we could lose up to 2 million barrels per day of crude and condensate exports into the global market. That is 2% of global supply, but OPEC Plus has 5 to 6% of reserve capacity of global oil demand. So it can easily replace 2 million barrels per day of lost supply. But if it happens, if they hit oil infrastructure in Iran, markets will start to think, what's next? Maybe we get disruptions in a wider circle of the Strait of Hormuz, impacting massive flows of oil going through that strait. Of about 20% of global supply is flowing out there. And if that was to be disrupted, then of course the oil price would explode and rally to $200, $300 per barrel if it was an extended outage of supply through the Strait of Hormuz. But the market at the moment is not pricing in any probability of that happening. But that kind of probability would get closer and come closer if Israel hits oil infrastructure in Iran.
And definitely, we do hope that the G7 nations can possibly, control this kind of retaliation. It doesn't really happen. But if it happens, Bjorn, can this really upend the global energy markets? You're suggesting that it will not really have much of an impact, but also that OPEC statement coming in that there is surplus oil production and of course, in Saudi Arabia and UAE as well. However, if that retaliation happens, then that Hormuz Strait will get affected. So at this point, can a long-term view on crude be taken?
No, I think, the oil market is never in balance. It's either in surplus or in deficit. And if we lost a large chunk of supply through the Strait of Hormuz, oil price would first rally, then you would get a global recession, and then oil price would fall back again. So it wouldn't really impact the long-term price of oil that much. Maybe, it would actually inspire China to race yet faster towards EV, electrified transportation, and away from oil.
Okay, let me then ask you this question about the important jobs data that has come in. Of course, there is much to be cheered so far as employment data is concerned, job creation is concerned. In fact, unemployment rate has dipped to 4.1% from 4.2% in August, and of course, we're seeing some gains build up on Dow Jones and of course other indices as well. So far as the U.S. market is concerned, so anything that happens over the next few days, you think that will be temporary? What are the larger fears so far as the U.S. economy is concerned, because we've seen Fed rate cuts also come in. Then you have today's jobs data. What do you really make of the U.S. market construct?
I mean, the reason why the Fed reduced the interest rate by 0.5% in not too long ago was because indicators were coming in weaker, inflation was coming in weaker, and of course the stronger jobs report we got now is probably going to influence the rate path, and we saw the 10-year bond actually get a hike in rates right after the data. So further reductions in rates might be slower with this strong report, but it's good news. It's good news for Kamala Harris because a good economy is always great for the sitting president, which is partially sort of Harris, partially Biden. But of course, what could impact heavily, we know that Donald Trump, he is attacking Biden-Harris for the inflation we've had in the latest years. So if we get an attack on oil installations in Iran, oil price would naturally fly to $100. Gasoline prices in the US would rally up, and that could tip it in the favor of Donald Trump again. So it has a big potential impact on the US election.
Absolutely, Bjorn, and those elections are coming up in November, so we don't have much time left for that to happen. But what are you penciling in for the U.S. markets? Anything you'd like to talk?
I'm mostly focusing on the oil market and as such, mostly on what OPEC is going to do, how supply-demand balance is going to look like, and our expectations is that OPEC Plus, even though they are saying we are going to lift production in December by 180,000 barrels per day,
yes,
it doesn't mean that they might that they have to lift it by the same amount every month to November next year, which is on the cards, the plan, but I think they are going to still control the price and the volume of supply into the market, and we expect an oil price of $75 per barrel, which is great for the global economy. It's good for OPEC and good for producers.
Bjorn, we are completely out of time. I'm afraid we are completely out of time, so I have to interject here, and apologies for that. We want to take one final question from you, considering that we are sitting right here in India, so we have to ask you one question about the Indian markets as well. Indian markets have completely, particularly come out strong in the past few months. However, we're seeing some sort of nervousness. FIIs are seeming, nervous and jittery. There is the Chinese economy boost ashore that has also come in. But what do you make of the fundamentals so far as the Indian markets are concerned?
Well, I think it's interesting to look at the manufacturing PMI in India. It has been holding up strongly for a long time. Yes, maybe it's hit on the equity market, but we've seen very strong manufacturing activity in India, much higher than the rest of the world, and the US then accelerating with the positive data on jobs is good for the whole global economy, because the US will demand more of everything. So eventually it will trickle down to all the rest of the world and be positive for India as well.
Absolutely. On that note, thank you very much, Bjorn, for joining us right here on ET Now. Once again, thanks very much.